The Dow just went negative for the year. For the first time in 2026, the bulls are losing the battle. And what is happening underneath the surface is worse than the headline suggests. On March 5th, the Dow Jones Industrial Average dropped 784 points, or 1.61%, closing at 47,954. The S&P 500 fell 0.5% to 6830. The Nasdaq dipped 0.25% to 22,749. All three indexes are now either negative or barely positive year to date. The gains from early 2026 have been completely erased. So what is driving this? It is not one thing. It is a cocktail of catalysts that are all hitting at the same time, and that is what makes this so dangerous. First, the geopolitical shock. The conflict between the United States, Israel, and Iran has escalated dramatically. Iran hit an oil tanker with a missile. The Strait of Hormuz, which handles 13 million barrels of oil per day, is effectively disrupted. West Texas Intermediate crude surged 8% in a single day to over $81 a barrel. Brent crude is pushing toward $87. Some analysts are now warning that $100 oil is on the horizon if this persists. That is a tax on every consumer and every business in the world. Second, tariffs. The 15% global tariff implementation is creating cost-push inflation that hits manufacturers, retailers, and ultimately your wallet. Steel and aluminum tariffs at 50% are crushing industrial margins. Companies cannot plan when trade policy changes every month. Third, the labor market is cracking. The February jobs report came in far below expectations. ADP private payrolls were only 63,000. Benchmark revisions wiped 900,000 jobs from 2025 data. The unemployment rate is at 4.3% and rising. This is not a healthy labor market. And fourth, the Fed is stuck. The federal funds rate is at 3.5 to 3.75%. Inflation is still sticky because of oil and tariffs. The labor market is weakening. The Fed cannot cut into inflation, and they cannot tighten into a slowing economy. This is the definition of stagflation risk. Rising prices plus slowing growth, plus a central bank with no good options. The Dow going negative year to date is not just a number. It is a psychological milestone. Institutional investors use year-to-date performance as a benchmark. When it flips negative, it triggers repositioning, risk reduction, and defensive rotation. Money flows out of cyclicals and into treasuries, utilities, and cash. That creates a feedback loop that can accelerate the decline. The S&P 500 failed the 6,900 resistance level and is now trading around 6,800. Technically, the next support is 6,500, and if that breaks, you are looking at a full correction. The Nasdaq is holding up relatively better because of AI names, but even that is fragile. There are a few bright spots. Broadcom earnings showed resilience in semiconductors. NVIDIA just posted $68 billion in quarterly revenue. The AI build-out is real and ongoing, but even the strongest sectors cannot carry the entire market when the macro backdrop is deteriorating this fast. Here's what to watch going forward. The next Fed meeting in mid-March, the next CPI print, and oil prices. If any of those break the wrong way, this sell-off gets significantly worse. If oil hits 100, if CPI reaccelerates, or if the Fed signals no cuts for the rest of the year, we could be looking at the beginning of a real bear market. Are we there yet? Not officially, but the warning signs are flashing. Subscribe because we are covering every twist in this market. Drop a comment with your prediction, not financial advice.